Hello. On behalf of FCS Financial, I would like to welcome you and thank you for joining us tonight. My name is Jeff Brody, and I am the crop insurance team leader from the St. Joseph, Missouri branch. 2020 has thrown a lot at us, and I'm excited to host this team of experts to explain crop insurance changes in 2021. First, I want to go over some logistics of the meeting tonight. On the bottom of your screen, whether on a smart device or on a computer, you should see a toolbar. The audio options will allow you to change your audio settings. If you click on it, you'll see several other options and help sections as well. All the attendees are in listen-only mode tonight, which means your cameras and your microphones are not on. So don't worry about us being able to see or hear you. You should see the Q&A box, and this will allow you to submit any questions you have for our presenters. We'll plan to take a few questions at the end of the meeting, time permitting. Next is the raise hand button. You can use this if you have any issues, and we'll send a chat to see if we can help. Finally, you'll see a chat button. You can use this to communicate directly with me when my camera's off. I'll do my best to help with whatever I can. If you're having any technical difficulties, often logging out and logging back in can help. If you're having audio issues, sometimes calling in from a phone can be a more reliable option than listening over the internet audio. As we begin tonight, I would like to mention there is no way that we can cover all the details about the crop insurance program in a brief meeting. But please feel free to contact any of our branch offices, and our staff will be glad to assist you in getting in touch with a crop insurance agent that will answer your questions. Certainly, 2021 has started with optimism based on the value of our cash grain markets. As we look forward to that, I would like to remind you that it will have an impact on the cost and guarantees available on your insurance policy. When you couple better commodity markets with widespread drier conditions, we feel these topics that are presented tonight will bring valuable information to assist you in making sound risk management decisions for your operation. Our first speaker this evening is Mark Croker. Mark is the Assistant Vice President of Marketing with Rain & Hail Insurance Company, based in their Midwest Division in Johnston, Iowa. With that, I'll turn it over to Mark to inform you about the new Enhanced Coverage Option, or ECO, and the Supplemental Coverage Option, or SCO. Mark?
All right, thanks, Jeff. First off, very appreciative and excited to be able to join you guys tonight. We're going to talk a little bit about a couple of endorsements that you can add on top of your multi-peril policy that, and I think maybe one of the best ways I've heard this described is the ability to essentially add some cream to your coffee. So the main component of your risk management, still has the ability to still be your multi-peril, your revenue, yield protection coverage, but this could add a little bit of creamer or maybe even a little bit of flavor to it if you like that in your coffee. And we're going to run through a couple of different options for that. So the first one being supplemental coverage option. This has been around for a few years. This was actually added, I think, in the 2014 Farm Bill. That's been out there, but it ties in nicely to a new enhancement, no pun intended, the enhanced coverage option that is new for 2021. So we'll cover both of these at a really high level, kind of how they work, and then we'll talk a little bit about where might they fit in your own risk management strategy to go from there. So the first thing off is going to be the supplemental coverage option. So Shane, if you could go to the next slide here, really at a high level, what is it? So both of these are actually area-based plans that are going to sit on top of your multi-peril coverage. So SCO, because everything in insurance that's official has to have an acronym. So SCO, Supplemental Coverage Option, is going to be an area-based coverage that sits from whatever coverage level your multi-peril policy is at and go all the way up to 86%. So if you're at 80, you've got 6% coverage. If you're at 75, you've got 11% coverage with SCO, but it is area-based. So our next slide here, we're going to talk a little bit about kind of more of the details on how this works. So very simply, the coverage, and what I mean by coverage is the way the policy is going to work is going to mirror the underlying policy that you have for your multi-peril protection. So if you have revenue protection, SCO works as a revenue protection policy does. If you have yield protection, then it will work as a yield policy and require a bushel loss. One thing that's a little unique, although these plans are coverage-based, is the amount of coverage that you're going to get is actually going to be based on your own APH. So you're going to use your own APH to help determine the amount of coverage you get, but the tie to your policy ends there. So from there, everything is county-based. All the claims, all the revenue, everything is going to be based on how your county does. And that's all using RMA data. So simply put, I guess, is kind of a roll-up of everybody's production within the county to go from there. But it's all county-based. One thing that should be noted about that is, in order to determine if there's been an indemnity or not, all that production has to have been reported. And so when these get paid is a little different than what you're used to with the multi-peril policy. So typically, you're going to harvest, let's say with our spring crops, you're going to harvest in the fall, and we're working claims right after that. With these, they actually would not get paid until the following late spring, early summer, usually around June would be when these would be looking at. So there is a bit of a lag in terms of when an indemnity payment would be paid on these policies. So what do you need to know about SCO? A couple very simple things here. Again, these are high level, not all the details. So you want to talk to all your agents to get down to the nitty gritty with that. But it does need to be elected by sales closing of the underlying crop policy. So coming up on our March 15th deadline, it's a big major deadline for our spring crops. SCO would have to be elected on your application along with that. It does need to be written in the same place as your multi-peril policy. So this is an endorsement to it with SCO. The biggest thing I want to hit on this slide here, though, is that third shape there. So you cannot elect SCO and enroll in ARC on the same farm number. So I really want to stress that one to you. So you are not eligible for SCO if you'd enrolled in ARC on that farm number. So what's super important is that you're communicating to your agent if you enroll in ARC in which farm numbers you did that on. And so that way they can exclude SCO from that and you don't get hit with a penalty. So it's a pretty hefty penalty that changed recently to where it would be a 60% penalty if that wasn't disclosed at the right time. So make sure you're communicating with your crop insurance agent, whether you're enrolling in ARC or PLC, if you're going to elect SCO. And then the last thing there is this does have a high subsidy. So it's 65% subsidized. So you could say you're getting some good value for your premium dollars in terms of the amount of coverage that you're going to get when it comes to SCO. Next slide here, we're just going to hit a couple of basic things around some things that are excluded or just things you need to know. So since SCO is an area plan, then you can't combine it with other area plans. So if you purchased margin protection this last fall, or if you don't buy multi-peril and you're buying ARPI or area risk protection, which is essentially a county plan, you would be ineligible for SCO. One other thing to note is it is available if you're electing HRAs, but you do need to add SCO to the HRA's contract in order to add it there. So that is SCO in a nutshell. It's not a super complicated product. Again, the biggest thing, I guess maybe the biggest two things, it's going to cover from your coverage level on your multi-peril policy up to 86%. And just remember that if you elect ARC, you're not eligible to have SCO on those farm numbers. But the new thing, the new option is the enhanced coverage option. And this is brand new for 2021. You're going to see a lot of similarities to SCO when we talk about ECO with the enhanced coverage option. So what is it? Really, essentially, it's SCO, but at higher coverage levels. So you can buy up to 90 or 95% coverage with ECO. And there's a lot of similarities to SCO with how it works. So simply put, extremely similar to SCO, but higher coverage levels up to 90 or 95. And this would actually sit on top of your SCO. So the next slide here, we'll talk again just a little bit about the details, and you'll notice this is exactly the same as SCO. So it's going to follow your underlying policy as to whether it's a revenue or a yield plan. Again, the amount of coverage that you're going to get is going to be based on your underlying policy's APH. So it's going to be your APH. but then it's going to be county from there. So county yields, county revenue that you're looking at in terms of whether it triggers a claim or not, and then indemnity would be the following summer. So a couple of details, again, very similar. It does have to be purchased by the sales closing date of the underlying crop. So we're coming up on March 15th here. It does need to be written in the same place as the underlying policy. But one thing I want to mention here is you do have the ability to purchase both SCO and ECO if you desire. So I'll show you a graphic here, I think on our next slide, how that looks. But you are not required to purchase both. So you can elect one or the other. You can choose to just go with ECO, just SCO, or have both. You'll notice a little lower subsidies when it comes to ECO as compared to SCO, and the reason why would be those higher coverage levels. So if you have a yield protection policy, it's a 51% subsidy. Revenue protection would be a 44% subsidy. So our next slide will be the exclusions. Again, can't couple that with other county plans, so you cannot buy it with margin protection or ARPI. Acres insured with a CAT policy are not eligible for ECO. And then again, you can purchase it with HRAs, but you do need to add it to that contract. So here's the slide I was referencing. And I just like this visual because it kind of shows you how things can stack up. And essentially what you're looking at here is potentially reducing the deductible that you have. So less money out of pocket if we're looking at a disaster. And then again, with these, they're being county-based plans, so it would be a widespread disaster that would affect your county. But if you look here, this example on the bottom range would be your multi-peril coverage. Let's say you have 75% coverage. You have the option to cover from that up to 86% with SCO. And then you could add ECO on top of that, going up to either 90 or 95. Remember, you're not required to purchase both. You can do one or the other. You could just buy ECO and leave a little gap in coverage from 75%, but pick those top layers and catch some of the shallow losses that you could with ECO. So we're going to walk through an example just of how ECO works. I'll try to walk through this rather quickly and just try to give you a summary of what this means. But we're going to take an example of an area expected yield of 151.9. If memory serves, I think this is Macon County, Missouri's expected yield. And we'll just use a projected price of $4.30. So if you're not aware, we're currently discovering a price we're going to use for crop insurance. It'd be the February average of the December futures for corn. So we're just going to plug in 430 right now, and we'll see where we land come the end of February here. But in this example, you're going to use 95% coverage. So the first thing you do is figure out the coverage range, which is the difference of your coverage selection down to 86%. In this case, at 95, you've got 9% coverage range. And this producer is going to have an approved yield of 162. So this guy's averaging a little better than the county, so roughly 10 bushels higher than the county. So you're going to use that APH to determine the amount of coverage that you're going to get. So we're going to take the price times the grower's APH, which is 162, times 9%. So in this situation, you're getting just short of $63 an acre in coverage. The next slide here, we'll fast forward to harvest. So harvest time, we lost a little bit of price. We went from $4.30 down to $4. And we also lost just a little bit of yield, around 7 bushels of yield in this county. We went down to 145 bushels. So the final revenue for the county is going to end up being $580. So we're going to determine our loss percentage, take 95% minus that final area revenue divided by your expected area revenue, which was $653, and it comes out to 6.2%. The next slide here, we're going to take the 6.2%, divide that by our amount of coverage. So in this case, 9%, because we had 95% elected. And that gives us a payment factor of 68.89%. So essentially, you're going to get paid 68.89% of your amount of coverage. So in this case, we take that times our $62.69 in coverage, and we end up with a payment of $43.19 per acre. And if you notice here, pretty significant payment with really nothing drastic happening, right? So we lost 30 cents on price, we lost 7 bushels on yield. So overall, you know, not a major disaster or anything that rolled through, but it shows you what that really high trigger at that 95% level does and how quickly that's going to pay out. So why would I want to look at ECO? What are some of the benefits that may come along with that? So clearly, like I just showed you, it can cover shallow losses. You have a high trigger there at 95%. You can also choose 90, obviously a little less cost with that, but it's going to help cover some of the shallow losses. I know this year with prices being where they are, folks are wanting to try to protect that price, and this could help cover a shallow price loss. Now, there's some premium that comes with that, right? Because it's a very shallow trigger. It's going to trigger really quickly. And so that's going to cost more than a lower coverage level policy would, but you can see there's some value there if you're looking to cover shallow losses. One thing I could throw out there as a potential benefit is the fact that you get a different variable since you're using county yields. Now, I think county plans have kind of taken a bad rap, over time, because people would much rather prefer to have coverage on their own farm, understandably. But the biggest difference with some of these newer options with SCO, ECO, margin protection is you can get a little bit of best of both worlds there. So you're not sacrificing your individual protection, where with, back when GRIP or now ARPI, it's one or the other. You're either all county or all individual. With here, you get to do a little bit of both. So you keep your own individualized coverage, but I can layer it with some county protection on top of that. So you're dealing with some different variables there. Maybe the county had a loss, but you didn't. Maybe you had a really high APH and outgrew that shallow price loss, but the county had an average yield. So kind of mixing up your risk management portfolio, or essentially not having all your eggs in one basket, could bring some benefits to you. Now, it can work both ways, obviously, but there could be some benefits depending on your situation on mixing that up a little bit. As I mentioned earlier, you can have both SCO and ECO, or you can choose one or the other. So again, if you're really worried about shallow losses, you could elect ECO. You don't have to elect SCO. Maybe you're going to enroll in ARC and you're ineligible for it anyhow, but you can mix and match those how you want. And the other last thing I'd mention is just you have choices available. So you have different coverage levels with the 90 or 95 that you can choose from. You also have different coverage percentages that you can choose and essentially lower the amount of coverage that you get to help soften the blow of some of that premium. So if you love the concept, you're interested in this, but that initial quote at those higher levels give you a little bit of sticker shock, then you've got the option to back off some of that coverage, cheapen that premium up a little bit. So you can work with your agent on that and what's the best mix for you. What amount of premium are you willing to spend, to get some of this protection here? So next couple slides, just to mention, we have a couple of tools that are out there that can kind of help you with this. So I'd recommend just talk to your agent if you're interested. They can walk through with these tools with you. But the first thing is within our quoter, the ability to just kind of compare some different scenarios. So if you're debating either between different coverage levels, or do I want SCO or not, this will help you figure out how much coverage am I getting, what's the premium associated with that, how much weight here is on the county versus how much weight is on my own policy, on my own farms, things like that. The other tool that we have that personally is my favorite, I just love, is we have a simulator. And you can just go in there and model out different scenarios and how are these policies going to work for me. So, we mentioned earlier, we had a 430 price. We had a little bit of a shallow loss on price. What's that going to do? Or what's it going to take to get to the point where I'm making up the premium that I spent? What really am I getting for this? what's it going to take to max this out? So you can just go in and model different scenarios, model yield losses, combination of that with a price loss, and just see how's this really going to work to help you make an informed decision as whether this is something you want to go down this path or not. So with that, I'm going to turn it back over. Hopefully this was helpful. I know this was a quick overview of this at a really high level, but a new option out there I think is going to be getting some buzz this year. So something that you'll want to work with your agent, take a look at, and see if that's something you have interest in. So again, appreciate the opportunity to join tonight, and we'll turn it back over to Jeff.
Mark, thanks for your input on both ECO and SCO. We will now transition to some rules that have changed for Prevent Plant. For this topic, we have two gentlemen who are with the Great American Insurance Group based in Lawrence, Kansas. Speaking, we will have Randy Barr, the Underwriter Analyst Director, as well as Claims Manager Brian Johnson, who he won't be on camera, but he'll be available to answer questions for us. Randy, please share with us the Prevent Plant changes that are coming up here now for 2021.
Thanks, Jeff. I get to talk about a topic that everyone hopes you don't have to take advantage of, the Prevent Plant. We just soon see you plant your crops and you just soon plant them, then exercise this part of the provisions here. But basically, RMA issued a new basic provision for the coarse grains that hopefully you've all had capabilities getting. It's that nice 44-page document that's government speak, easy reading, but it has all the different aspects of crop insurance. Anytime you have questions, that's the document that you can go to. The section I'm going to talk about is section 17 out of that provisions, which is talking about the Prevent Plant coverage. And there's 4 basic changes in it this year. So we'll hit each one. Some of them are pretty minor. There is one major one that we'll hit at the last year. The first one is in this section. If you have went into a county for the first time in 4 years, you haven't ever planted a crop in a county for 4 years, there's a procedure in place that you can file a Prevent Plant intended acreage report. Basically, the purpose of that was to tell us what crops you are going to plant this year. And then if you happen to be prevented from planting one of those crops, that is going to set your base acres for Prevent Plant payment. The change they have made now is if you are eligible to file a Prevent Plant or an intended acreage report in 2020, you can now file another one in 2021 telling us what you're intending to plant in 2021. The purpose for this is definitely for crop rotation purposes. Let's say last year you were planning to plant all corn, and this year you're going to plant all soybeans. Well, again, without this rule, if you were prevented from planting your soybeans, then we'd have to base eligibility off the corn payments to decide if you can get a payment or not. So this is a nice change, but I don't know how often it will actually come into play. Let's go to the next slide. The next one is they clarified that if you had a cover crop out there on the ground, and because you had that cover crop, that's what caused you from being unable to plant your crop timely, then that's going to affect your Prevent Plant coverage, okay? You can have cover crops out there, but as long as you get it terminated at time and then you're unable to plant your crop, then that's covered under PP. But if you had a cover crop that you couldn't get terminated and then you couldn't therefore plant your crop, then that could invalidate your PP payment on that. The next one is basically another change. If we had a first crop, second crop situation out there and you're prevented from planting your first crop or it failed, and you elect not to insure your second crop that you're going to plant. In the past, we had to subtract those acres from your Prevent Plant payment eligibility. Now they basically ruled that we don't have to reduce the eligible Prevent Plant acres for any of those acres planted to that second crop that you didn't insure. So this is a nice change that helps out on your policy also. This one, you're not going to see where this really benefits you any. And this is the biggest change, and we have some examples of this to work through some examples, but it used to be up in the northern states, North Dakota, South Dakota, Minnesota. They had in the prairie pothole region, which is an area that flooded a lot and had a lot of prevent plant payments in it. They put in a rule called the 1 in 4 rule. Well, now in 2021, this 1 in 4 rule has been expanded across the nation. So everywhere now we have to implement this rule. And what it is within the last 4 years, you have to have 1 year where you actually planted a crop, insured it, and harvested it. Okay. If you didn't harvest it and we had to come out and adjust it, if we have to do an appraisal, so you didn't do any harvesting of those acres, and that appraisal was due to flood, excess moisture, or drought, then that does not count as a year of actually planting and harvesting that crop. Okay, so that's one of the kickers on the whole thing here. And again, they expanded this nationwide, so it affects everybody. So let's go through a few examples here and see if we can really confuse you here. Okay, so our first example, we're got PP corn in 2021 here. So what the adjuster's going to have to do is go back the last 4 years to see if those acres have ever been planted, harvested, and insured. So in this case, the insured had corn and soybeans for all 4 years. Okay, so that's no problem. They have it insured. In 2017, on this 80 acres, we're just going to call field 1, they couldn't plant any, they were prevent plant on corn. 2018, again, it was too wet and they couldn't plant any soybeans on it. So they were prevent plant on soybeans. 2019, they actually were able to plant and harvest the corn off those 80 acres and it was insured. 2020, they planted soybeans. However, due to a flood, it was unable to harvest, so we had to do an appraisal on that ground. Okay. So here we come along 2021. Again, we can't plant our corn. So the question is, can we pay a PP loss in 2021? You want to go ahead and click, Shane? There you go. So is this 80 acres eligible for a PP payment or not? So we look at 4 years. And the answer is, yeah, back in 2019, we were able to plant and harvest corn. It was insured. Therefore, these 80 acres are eligible for a PP payment in 2021. So this would meet the 1 in 4 rule and we're good to go. Okay. Let's go to example number 2. Basically the same scenario that we were setting up first one, but this time, again, they were prevented from planting in 2017. And 18, they were prevented from planting. 2019, they planted and harvested rye. 2020, they planted the soybeans, but again, they couldn't harvest it. We had to appraise it for a claim. Okay. So in 2021, again, we're prevented from planting corn. Is that 80 acres eligible for a PP payment? Well, now when we start looking at this, again, 17, 18, and 20 doesn't qualify for sure. So what happened in 19 when we planted and harvested the crop? It looks good, except we didn't have rye insured in 2019. Therefore, that does not count as a year for our 1 in 4 rule. So in this case, we would not be able to pay a PP payment in 2021 because these acres are not eligible for a PP payment. Another example, this one is basically referring to new breaking ground. So in 2017, 18, and 19, this field 1 was always in pasture. 2020, we broke that pasture out, planted soybeans, and we harvested them. However, since this was uninsurable acreage because it hadn't been planted or harvested in one of the last 3 years, we had to do a new breaking written agreement in 2020 in order to insure those 80 acres. And you decided not to do that in 2020, so they were put on the policies uninsurable. 2021, again, you're prevented from planting corn on those acres. So is that 80 acres eligible or not? And again, the answer is it's not because it wasn't insured in 2020. You had soybeans insured on your policy, but these 80 acres were uninsurable because there wasn't a new breaking written agreement to make them insurable. So in this case, it wouldn't be. This is the one that might be the most often one that we have in our regions down here. And this is when you pick up ground, okay? So basically in 2017, 18, 19, and 20, this field was not in your farming operation. 2021, you go out and you either buy the ground or you cash rent it, and it's coming into your operation for the first time, okay? So, and you were prevented from planting the first year. Is it eligible for PP payment? And the answer is, right now, with the information we know, the answer would be no. Unless you can go back to the people that had this ground in 17, 18, 19, or 20, and they can provide you proof that they planted, harvested, and insured a crop on those acres anytime in those 4 years. Okay. So this is a very crucial one here because people are adding ground all the time to our operation. And just remember, if you can't prove that it had been planted, harvested, and insured in one of the 4 previous years, then that acreage is not going to be eligible for a PP. So one of the things that we definitely stress, or that we're kind of talking about, is when you go into these new agreements, say you're going to buy the ground, then probably part of the sale is you need to be sure and get documentation from the previous owner what has happened on that field one of the last 4 years, so that you'll have the documentation ready for the adjuster in case you get into a PP situation. This is the responsibility of the insured to come up with the documentation. However, all the companies are going to try to work together. I know we're developing stuff. If that land happened to be with another Great American insured, and we can document what happened on it in the last 4 years, we'll definitely pull that forward to help out. Where companies are working with RMA to see if there's any kind of data mining that RMA can provide to us up front. We know they can data mine afterwards and find it, after we've already paid the loss. So we want to know the information up front. But with the privacy laws there's a lot of hoops that we got to jump through to make sure we're not getting any information we shouldn't be getting. So again, we encourage you to work with the people that own the ground previously to provide you documentation so that you would have it. Now, in those previous 3 examples, 2, 3, and 4, where the acres didn't qualify, then what has to happen on these acres before it would qualify for a PP payment? Okay, and this is pretty strong here. Basically, the acreage will be considered physically unable for planting for PP purposes until the acreage has been planted to a crop, harvested, and insured for 2 consecutive years. The key here is that acreage is still insurable if you plant it, okay? So again, what we're saying is it won't be eligible for a PP payment, but that ground would still be insurable as long as you have planted or harvested a crop in one of the last 3 years or insured it. So you could get 3 years of PP payment and now it doesn't qualify. It still qualifies to be insured if you plant the crop on it. Okay. So in our examples here, if we actually end up planting and harvesting and insuring a crop on that acreage in 2022 and 2023, then again, beginning and starting in 2024, it's now became eligible for PP payments again. That has to be 2 consecutive years on that. The last change they made, again, this is a beneficial change. Basically, in the past, if we had 80 acres and we planted, or we turned in PP on corn on all 80, and then you actually ended up planting 20 of that acres to soybeans, we would have to pay that other 60 acres of prevent plant as soybeans instead of as corn. They've changed it now, so as long as you can provide proof that you were going to plant those acres to corn, then you're not penalized if you're actually able to get some of those acres planted to soybeans or some other crop. Okay. Now for that proof, you'd have to provide us that you had seed receipts for the corn or fertilizer inputs, anything that really backs up your intent to plant that crop that you were actually prevented from planting on. So this is a positive change on this one too. So here's the example of that. 2017, again, we were PP on corn, 18 PP on soybeans. 2019, we planted and harvested corn. We did have corn insured, so that's okay. And then in 2020, again, we had soybeans that failed, and we had to do an appraisal on it. So in 2021, we were intending to plant corn again. However, we weren't able to plant those 80 acres, but we were able to go in and plant 30 acres of soybeans after the late plant period of corn. Remember, if you plant the soybeans for the late plant period of corn, then that would invalidate your PP claim on corn. So planted after late plant period of corn, the 30 acres. First of all, is these acres eligible for PP payment? And the answer is yes, because in 2019, we did plant, harvest, and insured a crop on those 80 acres. And then the question is, what are we going to pay in on the PP corn? Well, again, as long as you can show proof that you intend to plant those 80 acres, then you could receive 100% PP payment on the 50 acres that you didn't plant to soybeans, and 35% PP payment on the corn acres that you did plant, as long as you meet all the other requirements on the prevent plant payments on that. Okay. And again, the key there is the soybeans had to be planted after the late plant period of corn. So with that wraps up our changes to prevent plan. Again, we're hoping that no one has to use prevent plant, that you get your crops planted timely. But if you do run into problems or have any questions, be sure and reach out to your agent on that. Jeff, I'll turn it back over to you.
Thanks, Randy. We hope that prevent plan is not a concern for 2021, but we appreciate you updating us on these important changes. The next item on the agenda will be the livestock risk protection, or LRP, changes, and the new quality loss option, or QLO. Presenting this information tonight is Sadie Conley. Sadie is an FCS Financial agent that serves customers from our Columbia and Macon offices. Sadie, please share with us these changes important for both livestock and grain farmers.
All righty, thank you, Jeff. So we're going to move on to livestock risk protection, otherwise known as LRP. So in case you didn't already know, LRP is a simple and cost-effective way of locking in a minimum price floor for your livestock. So this is a price protection policy. There have been some significant changes to this program for 2021, so I wanted to cover those with you guys tonight. Okay, so the first change that we have here on the slide is increased head limits. So a benefit to LRP has always been that you could insure as few head as you would like. So if you wanted to insure 5 steers, you could do that. But now producers have even more flexibility on the upper end of that. So for fed and feeder cattle, that has increased to 6,000 head per endorsement and 12,000 head annually. And then for swine, that's increased to 40,000 per endorsement and 150,000 annually. Another change here is that feeder cattle and swine can now be insured before birth. So this allows you to look ahead and take advantage of any market swings before your calves or your piglets even hit the ground. We do recommend that you follow your typical birthing rates here if you're going to utilize this, and not to insure 100% of your calf crop until they actually hit the ground. You don't want to insure more than you actually have. You don't want to pay excess premium there. The next change here on the slide is that premium is not due until the end of the endorsement period. So previously, that premium was due the day that we locked in the price and the day that we wrote the policy. We had to have our premium check that day. So now that is not due until that endorsement period has actually ended. So there are many different endorsement periods that you can elect from. Those range from 13 weeks on the lower end and up to 52 weeks on the upper end. Additionally, they have changed when your livestock can be sold. So previously you could sell 30 days before the end of your endorsement period or anytime after that. This has been changed to 60 days before the end of the endorsement period or anytime after. So this just gives you guys some more flexibility with the product with an additional 30 days to sell before the end of that endorsement period. Okay, on the next slide here, this is our final change on LRP, and this is the one that I consider probably to be the most exciting for our producers. And this is an increased premium subsidy rate. So remember that an increase in subsidy means a lower premium for our producers. Previously, LRP had a flat 13% subsidy rate. This increased for the 2021 crop year from a range of 20 to 35%. And then again in July for the 2021 crop year, that increased from a range of 25 to 35%. And then finally in September, those increased again, and the range is now 35% up to 55%. So on this chart here, you can see in the middle that this is where our current subsidy rates are sitting. This is substantially higher from that 13%. It does depend on what coverage level you elect as well, and you can see those coverage levels there on the left. One important thing to note here is that similar to your multi-peril policy, you must be in compliance with your NRCS or FSA office in order to qualify for this premium subsidy. So if you are interested in writing one of these policies, you're going to want to check with that before you do write one of these. Otherwise, your premium will be substantially more expensive. LRP is similar to a put option that you can purchase on the market. So with this increased subsidy rates, I would encourage you to take the time to compare the premium here with any fees paid to a broker for a put. LRP does move daily, and the quotes are often dependent on the volatility in the market. So contact your agent early and watch for any market movement there if you are interested. We can give you quotes every day that those prices are announced. That excludes weekends and holidays, or we can show you how to access that on RMA's website. Do keep in mind if you are looking at these coverage prices on RMA's website that those numbers do not take into consideration the premium subsidy amount that we're showing here. So if you do want accurate quotes, make sure you get in touch with an agent and we can help you out there. Okay, so our next topic is going to be the quality loss option, or QL. So this is a new option that you can now choose to put on your policy to improve your actual production history, or your APH, for any years in which you've suffered a quality loss due to aflatoxin, vomitoxin, any test weight issues, etc. This allows you to replace any post-quality production yields with a pre-quality total production. If you are interested in adding this on your policy for any quality losses that you might have suffered in previous years, make sure that you are aware that a claim must have been submitted from the year that you suffered that loss. So for example, if you suffered any quality loss issues in 2015, you had to have a claim on file that year. And then we also have to have claim paperwork from that year in order to use this. So do keep this in mind if you're considering transferring between different approved insurance providers, or if you're considering switching your agents. That claim paperwork doesn't always transfer. So it is your responsibility to supply that to us as well. The next slide is going to have some more info on quality loss. So you must have this on your application by the applicable sales closing date. So if you're wanting this for your corn or soybeans, we do have to have this on your application by March 15th. They are also this option is elected by a county crop basis. So if you want it for your corn, we can add it for your corn, but we can leave it off of your soybeans and vice versa. This will only apply to the applicable APH database in which you have suffered a quality loss in the past. So this QL option is a really beneficial option for our producers, but it doesn't necessarily have as wide of an impact as what we originally thought that it would. You want to look for years in which you've had high yields, but a quality issue brought your post-quality number down. A good example of this is vomitoxin in wheat. So in 2015, especially in central Missouri, we had really good wheat yields, but 2015 was also extremely wet. So those vomitoxin numbers were really high in some areas, and a lot of our producers were actually forced to destroy their wheat that year. So this would be a good option to add on to your wheat policy if you suffered any losses like that for your wheat in 2015. You also want to closely check with the other options that are available to go on your policy. QL is not a one-size-fits-all product, so you want to make sure that you have the best thing on there for your operation. For example, a lot of producers have the YA and YE options already on their policies. YA stands for yield adjustment, and this doesn't let the current year's yield fall below 60% of the county T yield. And then YE stands for yield exclusion. And what this does is it excludes specific low yielding years on a county basis. So for example, in 2012, you might have had aflatoxin on your corn, but due to the drought that year, you might have also had really low yields on your corn. You might be better off excluding 2012 as a whole on that corn unit by using the yield exclusion option rather than using the QL option. So this is just something to keep in mind when you're looking at this with your agent. Make sure that you are finding the right fit for everything on your policy. Again, this could be a very beneficial product for a lot of our producers. I would encourage you to visit with your agent about this for the upcoming year, or if you do suffer a quality loss in the future. So, Jeff, that's all I have for this evening. Thank you.
Thank you for those updates, Sadie. Next up, we will discuss actuarial changes for 2021, as well as the beginning farmer rancher, or BFR, and the veteran farmer rancher, or VFR program benefits. Shelby Twiner will be presenting on this information as an FCS agent serving customers for the Marshall and Sedalia branch offices. Shelby?
Thanks, Jeff. We're going to talk about the changes made to the BFR-VFR benefits regarding using another producer's history. Prior to 2021, a BFR-VFR could only use another producer's history on that specific piece of ground. They were farming as long as they had performed labor or made management decisions on that piece of ground. New for 2021, a BFR-VFR can use a previous producer's history as long as they have been involved in any farming operation for the crop they plan on planting. And that new acreage that they picked up has been planted to that crop in the past. So for example, say you are a BFR for 2021. You've been farming with your dad for the past 2 years, planting corn and soybeans. You decide to pick up a new piece of ground down the road. You've had nothing, and plant beans on it. You've had nothing to do with this farm in the past. And now remember, since you've had nothing to do with it in the past, but you have been helping your dad for the past 2 years on that new ground, with the previous producer's consent, you would be allowed to use their history for soybeans if they had planted that ground to beans before. Now, just a quick reminder, if you choose to use the previous producer's history, please remember that if you are audited, you are required to prove those yields, even though they are not yours originally. So just a quick recap, to be able to use another producer's history, you must have been previously involved in any farming operation. That acreage has to have a history for that crop, and you must have the previous producer's consent. Okay, moving over to the chart on the right-hand side of the screen. This is a comparison of the benefits of BFR, VFR, and new producer. BFR, VFR allows for the use of another producer's history, like we just discussed. New producer does not. When you qualify to use new producer, you are allowed to use the county T yield to establish your guarantees. Moving down to the max years of farming history, this is basically referring to the factor determining if you qualify for either of these options. For new producer, that means you have to have produced that specific crop in that particular county for no more than 2 years. For example, if you decide to plant soybeans for the first time in 2021, you would qualify for a new producer. BFR, VFR, you cannot have produced any commodity for more than 5 years to get those benefits. Now those commodities include livestock and crops. For example, if you have raised cattle for the past 15 years and then you decide to start farming soybeans in 2021, you would qualify for a new producer, but not BFR, VFR because you have exceeded those 5 years, that 5-year limit. And then lastly, BFR, VFR receive a premium discount while new producer does not. Okay, soybean non-irrigated T yield update. T yields, real quick, are the established county averages that are put in place by RMA. They are updated every 3 years and are used in multiple calculations, such as, like we discussed on the prior slide, they're used when you qualify for new producer. They can be used during a bad year as part of the yield adjustment option on your policy. T-yields are used to establish guarantees for all ground coming out of CRP, as well as for yields for new break written agreements are also based on the portion of the county T-yield. So like I mentioned before, T-yields are updated by RMA on a 3-year rotation. 2021 is obviously soybeans, 2020 was corn and wheat. Looking at the maps on the slide, on the left is 2020, on the right is 2021. The darker the red the county, the higher the T-yield. And several counties in Missouri saw an increase for soybean T-yield for 2021. Okay, soybean irrigated T-yield. These were updated also. Similar information to the previous slide. I will mention one more addition for use of irrigated soybean T-yield. If a producer has never had irrigated soybeans in that county, they do not get to use their non-irrigated history. They will have to establish a database using the irrigated T-yield for that county. All right, moving on to breached levees. So 2020 was a big year for breached levees due to the flooding in 2019. Looking at the map on the slide, each county that is in color had breached levees, and the darker the red, the more acres that were affected. For 2021, if you have acres behind a breached levee, the breach levee statement from RMA is still in place. So that means if the levee has not been repaired prior to the earliest planting date, the highest risk rating will be assigned to those acres. If the levee is repaired after the earliest planting date, but before a producer plants any crop on that ground, you can submit a high risk written agreement to RMA to request the risk rating be lowered. Your agent should have access to a list of all of the levees from the RMA regional office, all the levees that have been repaired back to prior specifications. Hopefully 2021 will be the last year we have to deal with breach levees for a very long time. If you have any questions, please submit them. We'll try to answer them at the end of the webinar. Otherwise, Jeff, I will hand it back to you.
Well, as you said, Shelby, I hope that we won't have to see any more of these breach levees. We'll get them repaired in 2021 so we don't have to deal with it next year, but do appreciate you sharing that information with us. For our last topic of the evening, we will cover crop insurance during the COVID pandemic, as well as a few updates and reminders on private insurance products. Presenting for us is Wendy Hall. Wendy's a team leader who also services customers from both the Harrisonville and Higginsville offices. Wendy?
Thank you, Jeff. We are coming up on a year now of being in the middle of a pandemic. And to say that the past year has been challenging is definitely an understatement. We've all learned how to function, and we're continuing to adapt in these crazy times. So last summer, RMA came out with several flexibilities to producers in regards to the COVID-19 pandemic. One that we wanted to mention that was extended into 2021 is leniency with self-certification replant claims. So this year, if you have 100 acres or less to replant per unit, you're eligible for the self-certification process. In the past, this has been 50 acres or less to replant per unit. So what happens during a self-certification process is you'll call your agent to turn in the replant claim first. The insurance company will send you paperwork to fill out. It will include how many acres you replanted, when did you replant, where did you replant, stuff like that. And then you will have to provide copies of your seed receipts from where you got your replant seed. You will gather all that information and send it back to the insurance company, and they will process your payment once they've received all the information they need. And an adjuster will never have to come out and look at anything or realistically contact you. The most important piece of this and any replant claim is to make sure you contact your agent before you replant. That is very, very important in order to get paid. Something else that we wanted to mention was over the last couple of years, RMA has deferred the accrual of interest on premium for several months. In 2019, this was due to poor harvest conditions, and in 2020, because of the pandemic. And we just wanted to mention that we have not heard that this will be the case this year, so you should be prepared that interest will begin accruing on your premium starting on October 1st for spring crops that are billed in August. At FCS Financial, we are committed to servicing our customers even in the middle of a pandemic. For the safety of our customers and our staff, our offices are currently operating under kind of a hybrid work from home, work in the office plan. So we encourage you to call ahead and schedule an appointment with your agent to ensure that they are in the office the day that you want to come by. Of course, we're still available by phone. We're available virtually, and we can come out to your farm. Over the past year, we have utilized DocuSign and e-signature a lot. It's so user-friendly. All that we need is an email address and for you to sign an e-consent form through FCS to be able to use this. We can meet with you over the phone or virtually, and then we can send the papers to sign via DocuSign. And it's instantaneous. I send it to you, you sign it, it comes back to me, I sign it, and we're done. So no waiting, a week or more for stuff to come in the mail or anything like that. It is a very fast and efficient way to get your paperwork done if you're willing to use that. Another great way to get us information is through precision farming technology. So all of the companies that we write for have an option for using precision technology. There are a couple of different things that we can do with this data. So we can pull this data directly through and upload it to your policy, or we can use different reports to create an acreage report or a production report like you typically would fill out. If you give us permission in cloud-based systems like My John Deere or Climate View, we can pull these reports and create their typical acreage report or production report. We can also pull data from Ag Leader. So several agents this past year utilized these precision reports whenever FSA was backed up and not able to provide us with good 578 information. It's a good way to get us the data quickly and efficiently, and it's your data, so you know that it's right. If this is something that interests you, please reach out to your agent and we can help get that set up for you. Next, I want to talk a little bit about private products. So at FCS Financial, we offer a wide array of private products from every company that we write for. We currently write for 4 approved insurance providers. One we wanted to mention for this year is the Replant Supplement option. So your multi-peril policy provides a standard replant coverage. For corn, this is the spring price multiplied by 8 bushels multiplied by your share. Soybeans, it's the spring price multiplied by 3 bushels multiplied by your share. These supplemental products provide additional coverage on top of your multi-peril coverage. So Jeff had mentioned earlier how dry it's been. This might cause some to want to plant early, although it's really hard to think about corn planting whenever it is literally 14 degrees outside, but it will be here before we know it. So depending on which company your policy is through, you can plant anywhere from 10 to 20 days prior to the earliest plant date for that crop and receive coverage on this supplemental replant option. With multi-peril, you don't have any replant coverage if you plant before the early plant date. So the policies are different from company to company. So make sure you talk with your agent to see what is available and what your options are. And this product you do have to sign up for by March 15th. Every company we write for also has additional revenue and production. Each of these products is very unique to the company that they come from. Some provide ways to ensure part of your deductible gap. Others provide ways to buy coverage on a different unit structure, just kind of some unique things like that. There are several options. So if you're interested in ways to get additional coverage on top of your multi-peril policy, make sure you check out these options. And finally, our most popular private product that we offer is a crop hail policy. So your basic crop hail policy covers hail, fire, transit, and vandalism. You can add on coverage for wind, green snap, and extra harvest expense. These prices do change from year to year, and they change county to county as well. And also, most wind prices have gone up this year, so make sure you're checking with your agent to get an accurate quote. I will say this is a very affordable option if you are looking to add some additional coverage on top of your multi-peril policy. You have to sign up for wind and green snap coverage by June 15th, and you can sign up for a crop hail policy at any time. With that, thank you guys for joining us tonight and taking time out of your chilly evening to join us to learn a little bit more about crop insurance for this year. Thank you.
Thank you, Wendy. Okay, now we've got time for some questions. We're getting close to the end of our evening here. And so if anybody has any questions, as I said before, there is a Q&A button that you can hit at the bottom of your screen. I do have a few here that have come in. Mark, I guess these are probably going to be directed towards you for ECO. If you were to pick a profile of a farm operation where ECO might work well, what would that look like?
Boy, good question. You know, typically people that have gravitated towards county plans have been those that have outgrown the county. So their APHs are higher than the county's APH, often outgrowing their own APH. And those have been some that have gravitated towards the county. And I think that profile still fits. You know, but really with the way like ECO is working now and with SCO as well, it really is a broad swath of, I think, who may be a good profile, because it really just depends on what you're trying to accomplish. You know, because you still are able to keep your multi-peril coverage level at a level that you're comfortable with for your own farm. And I think that's key. You don't, you know, you'd want to stay there. But if you want to try to capture some shallow losses and whatnot, you sure have the ability to do that with either one of those products. You just got to realize that they're county-based. But, you know, I think most of the folks that look at these products tend to be the growers that often outgrow their own APH. They trend with or better than the county in terms of their own yields typically.
Okay, actually, Mark, we've had a couple more come in for you while we've been talking.
Okay, great.
One here, does ECO coverage require PLC election like SCO?
No, there's no tie to ARC or PLC with ECO. So you can have ARC and you can elect ECO. So no tie whatsoever when it comes to ECO. Good question.
Then how does ECO compare to private revenue coverage products, such as, not your company, but such as RAMP and things along those lines?
Sure. Yeah. So like Wendy mentioned, everybody's got their own little twists on private products. We do too. So does, I'm sure, Randy with Great American and whatnot. But you know, the biggest difference I would say are the two obvious ones. One being, you know, individualized coverage versus county coverage. You know, and clearly there's differences there. You'll also probably see some differences in rate due to that as well. But the other, and maybe the most impactful, is ECO and SCO are subsidized where the private products would not be. So, you know, SCO is a 65% subsidy if you've got revenue protection, ECO at 44%. So essentially someone's paying around half of the premium for you of what that product should cost. So typically on the private products, you'd see those be a little, you know, if they're apples and apples to say an ECO, you'd see those be a little higher premium associated with those. That the power of that subsidy is a big thing.
Okay. That's what I've got for now, Mark, on ECO. I do have a couple of PP questions for Randy now.
All right.
Thanks, Mark. Randy, what advice would you give regarding the new PP rules when adding land, especially if the previous tenant would not be cooperative in supplying information if you had PP?
Yeah, The biggest thing, as I kind of mentioned earlier, was we would highly suggest that you try to put it into your cash rental lease, that you have to know what the ground happened in the last 4 years. So maybe the previous owner could help you get that information from the previous tenant, which is going to be tough. I know, especially if you're bidding against them for the rights to use that ground. But definitely if you're buying the ground, I would definitely suggest you put that in the sale agreement, that you have to have that proof, so you have it for your records.
And one more here, Randy. Will the new PP rules impact how PP eligible acres increase when land is added?
Yes, and that's, again, if you cannot prove that that ground had been harvested, insured, and planted in one of the last 4 years, then that added land isn't considered eligible for PP. Therefore, it will not increase your PP eligibility acres for that added land. And then the other gotcha on that is if you do end up planting that added land, which it is insurable, we'll count those acres that you planted against your actual PP eligibility base. So it can hit you twice on that. So that's why it's very important to try to come up with that 1 and 4 documentation for us.
Okay. That's what I have. Thank you, Randy.
Sure.
That's all I have here for questions for now. So we're getting close to wrapping things up. However, I do have one request for our guests. When you close out of this event, a survey is going to pop up. The survey is very important to our FCS Financial team, and if you could spend just a few minutes on that, we would greatly appreciate it. In order to make sure you stay aware of everything happening at FCS Financial, please visit our website and sign up for our email alerts. Also, make sure to follow us on Facebook, Twitter, or LinkedIn. We will have some giveaway items for those in attendance, and you will be contacted by Wendy Hall through email if you have won. Also, in case you missed it, next Wednesday, FCS Financial will be hosting Ag Hires founder Rory Culler for a virtual event. Culler will discuss best practices and tips for farmers to attract, hire, and retain quality farm help. This event is being offered at no cost, but we do require that you pre-register. Please visit myfcsfinancial.com to register or reach out to your local FCS Financial office or team member. This virtual event will happen next Wednesday, February 17th at 10:30 a.m. Finally, I'd like to thank you all for joining us tonight, and we hope you have a safe and prosperous 2021 season. If there's anything I or any of our team members can do for you, please not hesitate to reach out and contact us. We'll be glad to work with you, help answer any questions you may have. Thank you, stay warm, and good night.